Okay, welcome to this panel on public debt, on high public debt, I guess, in advanced and emerging economies. We have five great speakers, so I will just say their name and their job. I don't think they need much of an introduction. So we have, going from this direction. You never know which left, which right, but I know from here to there, we have Barry Eichengreen, who is a professor at the University of California, Berkeley, Carmen Reinhart, who is professor at Harvard, Bertrand Dumont, who is Director General of the French Treasury, Debora Revoltella, who is the chief economist of the European Investment Bank. And I wanted to make a joke and say that Pablo Hernandez is currently unemployed, but he told me that he's not. But Pablo was governor of the Central Bank of Spain until this summer, and from next summer will be the general manager of the Banque for International Investment. Bank for International Settlement, sorry, located in Basel, I get it. Next to the Euler Hotel, which is the dream of every economist. Yeah, yes. And but he's currently teaching, so he's not unemployed. So we'll start in the direction they mentioned. Barry and Carmen will give an overview of the situation, and then we will have Bertrand will talk a little bit about the situation in developing economies, and Debora and Pablo will talk a bit about the situation in Europe. So, Barry.
Thank you. So I will take Chairman Panizza's instructions literally, almost. He asked me to talk about the debt landscape in advanced countries and emerging markets, which leaves out an important part of the world, low-income countries which have debt problems of their own. So I'm not going to touch on them, taking my instructions literally. I am going to try to provide facts as much as I do opinions, and the part that I'm not going to take too literally is the 5 minutes. I hope not to go over by very much. So in an earlier paper for the Kansas City Fed's Jackson Hole conference, Serkan Arslanap and I put together an earlier version of this figure, which is here updated through the end of 2023. This is an unweighted average of data for 180-odd countries. So actually this one figure does include data for low-income countries. I think many people are used to seeing figures like this which aggregate across countries in dollar terms using market exchange rates, et cetera, which puts a heavy weight on the situation in certain very large economies. So this version is designed to give you a sense of what the world looks like from the point of view of the median country, unweighted average here, with the debt to GDP ratio on the right-hand scale and the solid black line, and the breakdown in terms of who holds this debt between various domestics and foreign investors as a percentage of the total debt, adding up necessarily to 100% on the left-hand side axis. So you can see the well-known fact about how debt ratios have been rising everywhere since the global financial crisis, with on average a brief respite due to inflation in 2021, 2022. And you can see the importance of non-bank investors, growing importance of non-bank investors, foreign non-banks in particular, hedge funds, ETFs, and so forth, as investors in this debt. One can do the same kind of figures. I would talk about them more if I had more time separately for the advanced economies, again, unweighted average, the major emerging markets, the BRICS, basically, and other emerging markets. In the interest of time, I would observe that where for the advanced countries, on average, debts came down with that burst of inflation and stayed down, they were already heading back up quite noticeably in the United States, upper right-hand panel in 2023. And there's a bit of a difference between the major emerging markets and other emerging economies as well, in that the major emerging markets, the China's, the Brazils and Indias of the world in particular, have continued to run deficits and issue debt big time. What leaps out for me is that US debt, as I said, is now heading up strongly again after that breather due to the burst of inflation. Major emerging markets show no interruption to those debt ratio increases, and that contrasts with other emerging markets where there has been some stabilization on average since 2021. So when I think about the prospects, I worry about what's going to happen in the United States, where Trump administration policies threaten to blow up the deficit yet further. So there are clearly big tax cuts coming, and there are not clearly big expenditure reductions coming. Here in this country, political disarray dims the prospects for fiscal consolidation in the short and medium run. There's a lot to worry about with US debt in the hands of the public on the order of 100% of GDP. France's debt to GDP ratio on the order of 112% of GDP. So I think many people in the room get questions from relatives over the Christmas dinner table or from reporters asking at what point will the markets lose patience, at what point will bad things begin to happen, and the answer obviously is we don't know, but we need to think further about that. From the emerging market point of view, Trump's fiscal and trade policies will make for a strong dollar in the short run and higher US interest rates, given inflationary pressures from tax cuts and tariffs and the like, again, in the short run, both of which will tighten the screws on emerging markets, given the global dollar cycle, given the fact that foreign currency debt has not gone away. So I perhaps predictably, perhaps understandably, push back against the view that the problem of original sin has been solved. If you look at this from the point of view of the unweighted average of 100+ countries, as I do here, you can see that there are a small number of large emerging markets which have succeeded in issuing the bulk of their public debt in their own currency, but a very large number of other emerging markets in developing countries that have not made significant progress on that score. So here again, the debt to GDP ratio is the black line, and the blue versus the orange shows you the shares of domestic and foreign currency denominated debt in that total, and those shares are pretty constant over the decades shown here. Prospects for consolidation, that earlier paper that I alluded to from Jackson Hole, my co-author and I looked at episodes of significant sustained consolidation. So Ugo, this is something that you and I did back in the day, a decade or so ago. We looked again, and we really found that there were only two robust correlates of large sustained fiscal consolidations: ability to grow the economy, raise the denominator of the debt to GDP ratio, and make spending cuts or limited spending increases more tolerable to the public, and low levels of political polarization. So that observation renders me pessimistic about the prospects. The IMF and the World Bank tell us that economic growth will be slower going forward than it has been even over the last decade. And we know from a variety of sources that political polarization is on the rise in many places. So that's the pessimistic story. I will end on an optimistic note. There are a few cases where countries have succeeded in bringing high public debts down very significantly. My favorite example is the country of Jamaica. So the debt to GDP ratio is on the left-hand scale, and the blue and the red dashed line, and the primary budget balance, or here surplus, is on the right-hand scale. So Jamaica brought its public debt ratio down over the last decade from 140% of GDP to 70% of GDP. And it did that almost entirely by running high single-digit primary budget surpluses, 7, 8, 9% primary budget surpluses, year after year after year for a decade, with only the exception of the first COVID year. So if there's a demand, if there's a lack of questions and answers, time permitting, I can talk more about how they did that.
Thank you very much, Barry. Now we have Carmen, which you'll focus on sovereign risk, I guess. The paper Barry mentioned had a great title, which was pure Barry. It was called A Surplus of Ambition.
So it's a real pleasure to be here. There's an element of deja vu. I was Barry's discussant at Jackson Hole, so I came in, and I'm going to make one remark before I turn in. Barry has, I think, given a wonderful global view of the public debt issues, and I concur with pretty much everything he said. I would add to that there is also the issue of contingent liabilities, which are much bigger now than they've ever been in the past. And these contingent liabilities, you know, are crop up as realizations of new debt for governments. During financial crises, we saw, you know, famous examples, you know, with Spain or Ireland or Iceland having very low levels of public debt, and all of a sudden seeing surges. So we have to keep that in mind when we compare the current environment with, say, the end of World War II, where there was a high level of public debt, but private debt was nil, and not to mention, of course, that the population was a lot younger, and the issue of Social Security and those liabilities were not anywhere close where they are today. But anyway, I did my mini discussant role there, and now I'm going to turn to the issue, which is very complementary to what Barry has laid out. My focus is going to be on trying to convey and perhaps convince you there's going to be what is factual, and then there's going to be what is my own views, that we have gone through more than a decade where debt accumulation and debt itself wasn't a prominent concern, and it wasn't a prominent concern in very significant way because the cost of debt servicing for the advanced economies was exceptionally low. And it was exceptionally low, notwithstanding the fact that debt had been building. It was exceptionally low because interest rates were, by any metric, any historic metric, exceptionally low. What I am showing in this chart here is a policy rate, a short-term policy rate for a global financial center. So between 1900 and World War I, I show the Bank of England discount rate from the end of World War I to 1955. I show the Federal Reserve's discount rate, and from 55 to the present, it is the federal funds rate subtracting out inflation. So this is a real interest rate. There are only 4 episodes in this period, and actually if you extend this back to 1800, there are still only 4 episodes where we had year in, year out sustained negative real interest rates, such as what we experienced between the global financial crisis and the round of tightening by central banks in response to the inflation spike. From 1900 to 2007, in that long period, average short-term real interest rates were around 0.9. By contrast, from 2008 to 2022, they were minus 1.65. And this is just using the Fed benchmark, but I think when you talk about debt, you have to bring in the cost of debt servicing. And notwithstanding the fact that we have seen, especially more so in Europe than in the US, great success in reversing the inflation spike in the US, that last mile is still being quite tough to bring down to central bank goals. Notwithstanding the fact that we're in the midst of an easing cycle, I find it difficult to believe, and now I part from factual to conjectural, I find it difficult to believe that we are going to return to the exceptionally low interest rate era that characterized the GFC to 2022. Let me highlight a few factors. In that era, in the run-up to that era, we also had seen gentle but very sustained declines in short-term interest rates. And the surge in buying of US treasuries by China played a major role in so the global saving glut that took the form of these large purchases of US treasuries played a major role. In an environment in which geopolitical fragmentation and tensions between China and the US are on the rise, and China's own growth rate has slowed down dramatically. Remember, that era was an era of double-digit growth for China. So they were constantly leaning against the wind. The PBOC was leaning against the wind, buying dollars to avoid an appreciation. We're no longer in that world. Also, that is pre-QE1, QE2, pre-global financial crisis. Then we had the very exceptional, fairly synchronous global financial crisis in which you had unprecedented expansions in the post-war era of central bank balance sheets. Those central bank balance sheets became even much bigger after the global not only after the global financial crisis, but during COVID. Again, that is another factor that kind of scale in monetary accommodation did a great deal to keep rates low for long. You couple those very exceptional developments with higher geopolitical risk and with higher sovereign risk. And I'm going to address quickly both the advanced and the emerging market counterpart. And when I say emerging market, I'm including anyone that's rated. So it's also, but notice that this is a numeric score of all the credit ratings. So Moody's, Standard & Poor's, and Fitch are all in there. It's unweighted. It is all the advanced economies. Advanced economies as defined, the World Economic Outlook. So a rating of 20, a numeric rating of 20 is your AAA rating. And I think the two takeaways that I want you to grasp from this is the global financial crisis was a major shock that advanced economies still have not fully recovered from. You know, the U.S. has seen credit rating downgrades. One of them came after the fiasco, one of the many 60-some fiascos of the debt ceiling negotiations and the impasse around debt ceiling. So advanced economies, France most recently, also have seen downgrades. I think this is also going to be a factor that would add to the burden of debt servicing in a way that we had perhaps not seen in the previous 2 decades. With regards to emerging markets, the decline in credit ratings has been even more pronounced in recent years. And again, this presents a challenge for debt servicing, particularly acute debt servicing challenges have been present, and Barry mentioned this, in low-income countries where approximately half of the low-income countries are either in debt distress or at high risk of debt distress. But this covers more the middle to low-income, middle to middle low-income country group, as there are relatively fewer strict low-income countries that the credit ratings actually cover. What is the takeaway of what I am saying? We had a period, and I'll conclude with this, we had a period in the 1980s where we had very high interest rates, very high financial market volatility, but relative to today, very low levels of public debt and lower levels of private debt. In effect, when Paul Volcker started tightening in October of '79, U.S. debt was at its lowest level, or close to its lowest level. So it's a very different environment. Then we went into the 2000s, in which financial market volatility diminished, interest rates continued to move lower, but debt levels were rising. I think in the wake of the inflation wake-up call, we have entered an era in which we have higher levels to contend with, higher debt levels to contend with, and higher volatility and higher cost of debt servicing coupled with that. The CBO has some stunning charts on the sharp increase in the U.S., even in just the very recent past. I'll stop here by saying that I very much also concur with what Barry said. The combination of this scenario with very difficult, there are no elegant and easy or politically attractive ways of reducing debt, means that we're going to be having sessions like this for some time to come. And for those of you that are students, this is a very fruitful area to work on for, I believe, some time to come. Let me stop here.
So now the academic told us what the problem is, the policymakers will tell us how they'll deal with it. So Bertrand, among many of the portfolios of the French treasuries, there is the Paris Club. So it would be great to hear a little bit how you see the situation going from that specific vantage point.
Thank you. I was actually, I will speak without slides, so you will have to focus on what I say and not what you can see on the screen. Thank you to Professor Panizza for his invitation, for this roundtable. A lot has already been said on the global landscape of debt and refinancing, but I'll try to focus more on the situation in emerging and low-income countries. With three main points. Try to have a nuanced assessment of the current situation, see how we can currently address these indebtedness challenges, and what are the room of improvement, possible progress when it comes to this type of debt treatment. On the diagnostics itself, I think a lot has already been said on the pressure on low-income countries, on emerging countries. But to put it in a nutshell, what I would say is that we see less a systemic debt crisis than a case-by-case situation with a variety of situations across the board. We are obviously emerging from a situation where with a global tightening cycle, with spending pressure for all countries, in particular resulting from the COVID response, and it put a lot of pressure on the financing conditions of many emerging and developing economies. Yet we are not in a HIPIC situation or a 1990 style systemic debt crisis. Situation is pretty different from one country to another. When you look at ratio, you see that the median public debt to GDP ratio with low-income countries, for low-income countries, is around 53% as compared to 70% back in the 90s. So there is a clearly very significant difference. You might have seen a figure that is generally referred to with a 50% of low-income countries that are either in debt distress or in high risk of distress. But this should be compared to the fact that this figure was 60% last year. So there is more an improvement than a more severe situation. At the same time, I think it's important to realize and to acknowledge that these countries are facing liquidity pressure, higher refinancing cost, and obviously huge needs coming from infrastructure needs, environmental needs, of course, meeting the SDGs, which present very important cost. So needs are there, but with a very different situation once again from one country to another. A way to differentiate across the countries is clearly the fact that some countries recently secured some access to the market, including sub-Saharan African countries. You've certainly noticed that for Kenya, for Benin, for Cameroon, we have seen during the last month successful bond issuance that secured some financing for them. Last point in this, or last element in this complexity, and you referred to the last speaker referred to it, is the fact that the landscape is obviously more complex than it was 20 or 30 years ago, with new public creditors that have a very significant share of emerging countries' debt, with a new importance or more significant importance of private creditors, and of course you have the traditional role of multilateral creditors. So this being said, how do we address this challenge, and in particular the specific situation of countries that faces over-indebtedness? I think that what we have seen in the last year is that the Paris Club has been able to bring its expertise, its experience, somehow its know-how in terms of debt treatment to the common framework, and we have now set up a new approach in terms of debt treatment, which has indeed produced some results. I think the common frameworks properly reflect this new landscape of creditors. Clearly, China, India, Saudi Arabia are now around the table. I think it's important that it has delivered. We have seen a couple of successful debt treatment, to mention Ghana, Zambia, Chad, and to a certain extent the debt treatment of Sri Lanka is a spillover of this common framework method and common framework approach. But at the same time, it's important to recognize that it is only a tool, and at the end of the day, it essentially depends on the political willingness of each creditors to engage in good faith in the negotiation, and it takes some time to reach this result. So, final point, where are we today? Where do we stand in terms of debt treatment? I would say that we have made progress, we have achieved some results, but clearly there is room for improvement. The first one has to do with communication and transparency. More transparency vis-à-vis debtor country that sometimes consider as a bit opaque the treatment that have taken place, and would like to better understand how future debt treatment will work. I think it's also important to enhance the discussion, the dialogue with private creditors when it comes to comparability of treatment. And we know it has not always been easy to implement on a concretely comparability of treatment in these three cases. And obviously, we need to go quicker. As compared to what were Paris Club treatment, common framework treatment takes more time, are more cumbersome, requires more dialogue, more exchanges between the debtor country and the creditors. We've made progress, I was saying it, in terms now of better understanding each other, in terms of scope of treatment, in terms of methodology. So now the important thing is to deliver. On this, I'd like to make a side remark, because sometimes some observer suggests that we should find another approach, or perhaps another forum for debt treatment. I would dare argue that at the end of the day, what matters is the political willingness, the capacity to agree on principle, and the capacity to deliver on the negotiation. So I don't believe that if you were to conduct a negotiation, to carry negotiation in another forum or according to another format, you would get better results. What matters is more the substance and the willingness of the creditors than the framework itself. And here I think there is sometimes a misunderstanding of the role that the GSDR, the Global Sovereign Debt Roundtable, can play, because it's more a forum of exchange of information where creditors, debtors country can meet, exchange good practices, but they are not negotiating. And at the end of the day, what matters is obviously negotiation. So to put it in a nutshell and to stop here, I would say that against a mixed background, a nuanced background in terms of sustainability of debt of emerging and low-income countries, we have achieved some results. I think we have been to a large extent able to respond to the situation, to support IMF program, but at the same time, we are clearly, I'm not sure if I should say in the early days or in the middle of the road, but in the middle of a process where clearly further progress are needed.
Thank you very much. So I should say I was just in a meeting with the fund. I just published a nice new handbook on how the fund deals with the sovereign restructuring. They told me they consulted a lot with the Paris Club. So now we're moving to Europe. So we heard from Mario Draghi that we need to invest a lot of money, and Debora will tell us how the European Investment Bank will provide the money.
I think actually I will disappoint you because no, you started actually you asked me to speak in the panel about how to deliver on Draghi and deliver on investment, and I saw that I will try to bridge the gap with the huge challenge. I will not be able to provide the full answer, But I wanted to show where do we stand with investment and what is really needed in order to deliver on that. And I think I very much agree with what Draghi said yesterday, that if we want to avoid the slow agony, we really need a structural shift. And the structural shift can come, I see three areas: on the financial side, on the market side, the single market transformation, and partly on the fiscal. And my personal view is if we have to see where political capital can go, there is a little bit more agreement on a part on the financial market side, maybe something on the market liberalization, market integration side. I see it more difficult on the fiscal side, where the discussion is going very much at the margin on the mobilization, what can mobilization do, and not really what Draghi was talking about yesterday. So maybe that's in a nutshell what I will come up with my presentation. I just show a couple of slides. I have a lot of slides, so I will skip a few of them. But what I wanted to show is, in fact, that if we talk about investment, we are coming from a not too bad period in terms of investment. Actually, it's one of the periods in which investment has been strong in Europe in the history of the last 50 years. What we see is actually a very strong rule of the government sector that has been supporting investment. Now, clearly, there is a cyclical component coming in, and that's okay. On the private sector, we wanted the cooling of the economy, so that's coming. But at the end, we see this deceleration, but what comes of the last years is really the very strong rule of the public investment. And public investment has been strong directly in supporting investment and indirectly through investment grants from the government sector that actually have been very, very strong. So if you ever to think about the stimulus on investment coming from the public sector, we already come from quite an accelerated period of time. And I think this is important because we are looking for, and Draghi is looking for, an acceleration of 3 percentage points of GDP from today. So that's a lot more to come from a period in which particularly the public sector component has been strong. I skip this because we're basically saying it's coming also for a lot of the Recovery Resilience Facility and the EU funds. But what I wanted to show are two things. The first, almost forget it, it's a very back of the envelope, bottom-up approach that we do, looking at where investments are needed. I think there is no need to go on the details. We have a big figure, it's okay. We have to do a lot of investment. That's the point. On the second point, I was trying to look at when did we see phases of acceleration of investment in the recent history at the European level? And actually, I think if you go nitty-gritty what is behind, we saw some phases of acceleration. To my mind, they mostly are associated to the creation of the single market, to the euro area integration, to the possibly the last one following the retrenching of after the global financial crisis with some recovery and reintegration following a very big shock. Everything is coming with a big structural shift. So my point is really, if we wanted to re-engineer something like that, another big acceleration of investment, I'm very much with Draghi saying we need something structural shift big to happen. And then the point is what can happen? And I think I see three things, as I was saying. On the one side, on the fiscal, so I start actually from the financial side. On the financial side, I think the main point is we need more equity. We talk a lot about capital market union, capital market integration, financial market integration, but I think the real problem is really the equity side. And on the equity side, there is another way of looking at it. If you look at the gap in investment between EU, US over time, it's really on the intangible capital side. So it's really in ICT, and in the intangible capital. And it's going much better in the countries that have a more developed equity market. So to me, the point is really how we do something on the equity side. And here, it's a very complex point. You have to start from household propensity to invest and financial literacies, the rule of institutional investors, and I think we all look at the data with pension funds investing very little in equity, and if they do it, most of the investment is going out of Europe. And then there is also a part on venture capital. It's one part of the component. I think it's not the only answer. We as an institution are very much looking into it and looking at which part of the growth of firms shows a gap in terms of the support currently allocated. And we think there is something more to do, particularly in the phase of exit and scale up. But that's a part of a picture where a lot of other different pieces have to come into place. On the single market side, so that's my second point, I think there we have a survey. I always put this there. We have a survey that we run every year with firms asking what goes well, what doesn't go well, what are their problems. One of the questions we asked this year was, if you export to another EU country, what do you have problems with consumer protection, differentiated standard, etc.? 60% of firms in Europe say, yes, we have a problem. To me, when I saw the number, was shocking. It means our single market doesn't work. And I think we all, as economists, should work in making a super good paper, super strong case, bringing back the story of why the single market is so important. It's kind of out of the radar screen, the fragmentation of logistics within Europe, etc. What is the benefit for the European Union? I think we all remember the papers done 10, 15 years ago, but we have to bring back new evidence on the policy discussion. And the last point, and the most complex, is on the fiscal side. I think there is a lot of discussion on the new fiscal rules and if the new fiscal rules are constraining or not. I think there is an agreement among most of economists commenting on this, saying it's not a problem of the fiscal rules, but it's a problem of how government prioritize things when they have to constrain. And I think we have a lot of studies. We have at the EIB several studies showing that public investment is always the part that gets deprioritized, and the policy choices always do it in any possible moment. We also see that in cases, we try to look at when it didn't happen, that they didn't prioritize investment. It was in cases in which they couldn't, because investment was financed by EU funds, because investment was financed by the Recovery and Resilience Facility. So if you block the money for investment, the government has to use for that. So that's something positive maybe to think about. And then there is the last bit. I think, and is related to the graph I had before. Oh, no, this one. I think the gray part, these investment grants, because we come from a very, very high level, and we have to think at if they really can do much more and much better. And I think what we are doing now is looking at all the instruments that have been put in place in terms of supporting investment, and particularly for investment, particularly on the innovation side or on the net zero transition side. We actually tend to see positive effect. We see that normally the instruments actually lead to more investment in the area that they were aiming for. There are inefficiencies, and I think there is a lot more to do in terms of having a European approach in designing them. And like on that side, I also like the IMF paper that just came out that actually was very much pointing on the upside of doing using this instrument more with a European level. But again, I think this is one of the possible solutions. It's not going to be the one that will solve the acceleration of investment by 3 percentage points. And with that, I think I close.
Thank you very much, Debora. So now so Pablo used to run a large central bank. Now the BIS sometimes called the central banks of the central bank. So now he's going to run many central banks. What are the implications for monetary policy for all this?
Yes, indeed, I will be focusing on the interactions between fiscal and monetary. This is what Hugo asked me. And in order to try to answer to the different issues that could be raised these days in this context of high levels of debt, probably also higher R-G, also high deficits. It's not only an issue about the stock, it's also about the flow in many countries. And of course, as Carmen was saying, all the contingent liabilities that we have, in particular on pensions, of course, is an important issue in itself for fiscal, but of course also the interactions with monetary are relevant. And in order to try to give an answer, I will be referring to a policy paper that I wrote together with Sol Darbas and Jerome Zettelmeyer just some weeks ago, precisely at the request of the European Parliament. Okay, the European Parliament traditionally has a meeting with the ECB president, and they basically ask to outsiders for opinions that can be used in order to have a better conversation. And they asked Bruegel for such a paper on which they were asking about very relevant issues as to what extent the ECB was under fiscal dominance regime, to what extent the monetary policy of the ECB was creating moral hazard, what about the TPI, and also which were the opinions of Bruegel on the new SGP, the new fiscal rule, European fiscal rule, and to what extent this could be a game changer. So let me give you in a very quick and brief manner what the conclusions of our own work, which was basically a summary of the literature, because of course we only had 1 month in order to provide an answer. And by the way, many of the things that I'm going to say, in particular on fiscal dominance and moral hazard, have been written by Isabel in many of her speeches. So I at least think that at least she will agree with what I'm going to say. So first on fiscal dominance. Well, we all know that the European Monetary Union is under a monetary dominance regime, a regime in which monetary policy commits to an inflation objective, while fiscal policy is chosen to satisfy the intertemporal budget constraint for any given monetary policy strategy, okay, trajectory. And of course, there are a good number of elements in the treaty that try to ensure monetary dominance, for sure prohibiting the monetary financing of government deficits, making the ECB independent, but also requiring member states to avoid excessive deficits. So this was the idea that, market discipline might not be sufficient. At the same time, the fiscal situation in one country can create negative spillovers to the rest. So that was the main motivation for having a fiscal rule at the European Monetary Union level. So what do we know? What is the track record in terms of the evidence that we have in monetary or fiscal dominance? Well, the conclusion of the many different papers that have been produced is very clear, is that monetary dominance has prevailed. And let me give you 3 sets of conclusions that are robust in this literature. First, there is evidence that the European Monetary Union even generated a change in regime towards monetary dominance. And there is a nice paper by the ECB, by the way, on which colleagues from the ECB for France, they analyze fiscal policy and monetary policy from 1955 to 2019. And what they find is that France was under, a relatively soft fiscal dominance regime before entering into European Monetary Union, and after European Monetary Union, they moved to a fiscal dominance regime. And they do it basically by estimating fiscal and monetary rules and to what extent the monetary or the fiscal rule are aggressive in the case of monetary policy to what extent interest rates move by more or less than 1-to-1 to inflation, and in the case of fiscal, to what extent taxes rise by more or less than net real interest rate expenses. The second empirical evidence that we have is that when you try to incorporate deficit of debt, so fiscal variables, into the monetary policy rules of the ECB, they are not significant. Okay, so there is no evidence, again, of fiscal dominance. And then finally, I think, and also a piece of evidence that I think is interesting, I mean, in a fiscal dominance regime, you should expect a kind of correlation between fiscal variables and long-term inflation expectations. And again, you don't have any evidence of this link in the European Monetary Union. So that's about monetary and fiscal dominance. What about moral hazard? And well, the idea and the question here is to what extent loose ECB monetary policy has facilitated a fiscal expansion beyond, of course, what can be justified as socially optimal. And here, the evidence that has been provided by the literature is mainly on this period of very low interest rates, so just before the pandemic. And again, the conclusions are that there is no evidence of moral hazard. First, the reduction of government interest expenditures during 2014-2019 was not accompanied by a reduction of the primary balance, of European countries. Second, there is even evidence that compliance with the rules, with EU fiscal rules, even improve on average. Of course, with some exceptions, that's always the case. And here, what the literature does is basically to use these indexes of compliance with the fiscal rules that are now well known in the literature. And then finally, I think it's also very important to say, and by the way, this is also prevailing today, that the bond purchases programs by the ECB did not prevent sovereign spreads and bond yields from reacting to events with clear implications for sovereign risk. Third question that was raised by the European Parliament to us was related to TPI. And the point that at least we were making in the paper is that, in our view, the TPI could even strengthen market discipline. The way the ECB, and of course I was part, so here I might be a bias because I was a member of the council at that time, the way it was designed, in principle, should strengthen market discipline. And this is basically because of the conditionality that it has. You know that the Eurosystem will be able to make secondary market purchases of securities issued in jurisdictions experiencing a deterioration in financing conditions, but there are three elements that are relevant. First, that they should be disordered. Second, that they should be not warranted by country-specific fundamentals. And finally, and this is the important point, that it can only be used in countries that pursue sound and unsustainable fiscal and macroeconomic policies. And again, what we have seen, even in the last weeks, is that the spreads are reacting to events and to policy events in particular. And I guess this is also, and by the way, also governments are reacting to the market reaction. So I guess that the TPI, to a certain extent, could even strengthen the market discipline. And then final point on the new fiscal framework. So the conclusions of the analysis that we do in the paper is basically that, well, to a certain extent, I guess we all agree that the economic rationale of the new framework is higher. Okay, and this is basically because the new framework is now focusing on precisely on debt sustainability. Also because it's allowing to make this link that it exists in economics between structural reforms on the one hand, public investment on the other, and growth and debt sustainability in the end. And also because it's putting a lot of emphasis on as an intermediate target, at least, on an expenditure rule. It is true that the new framework also includes numerical safeguards to ensure ex-ante minimum pace of debt and deficit reduction, which reflects probably a mistrust in the DSA approach, at least by some countries. But in general, I would expect that a framework that it is perceived as more economic rationale than the previous one, it should also be followed stronger by countries. But here, let me take one sentence that was taken, that was mentioned by Bertrand when talking about emerging countries. In the end, it will be about the willingness of countries. So it's about the willing. We can have the best fiscal rule, but in the end, if countries don't have the willingness to apply the rule, this is not gonna work. Final point, of course, and very much related to what Debora said. I was not able to listen to Mario Draghi yesterday night, but I can imagine what he said on the need for investment, and also for the need for public investment in Europe due to climate change, to digitalization, to defense also. So how to square the circle, no, of providing this investment to Europe and at the same time fulfilling the SGP. This is probably the big question that we all have to answer. The only answer that I have is, of course, advocating for a common permanent European financing instrument. So that in the end, most of these aspects, for sure, climate change, defense, as well, even probably digitalization, are the global public goods. So it makes a lot of sense also that they are financed commonly by Europe, and at the same time this would allow also countries to alleviate the expenditure burden that, at least the investment burden that it is linked to these needs, and in the end it will square the cycle that we are all facing as a big problem for Europe. Thank you.
Thank you very much, Pablo. So you know, when you chair a panel, you worry about having great content, which we did well, and then you worry about the clock, which we did not so well. So we have a little bit more than 15 minutes left. I had promised you a second round, but I would also like to get some questions from the audience. So if you really have one thing to say in 1 minute, I'll give you 1 minute slot. If not, we take a few questions. You back your 1 minute? You're all back. So let's take 3 questions, and let's see. There you have a microphone next to you. Okay, I see Lucrezia. The microphone it's embedded in the chair.
Okay, so just a question. You mentioned China briefly when you talked about the Paris Club, but China as a creditor has increased tremendously his weight at the expenses of the Paris Club. Can you elaborate a little bit more about what this implies also in views of the geopolitical risk that we emphasized in the last few days quite a lot in this conference? Thanks.
If there are, I'm willing to take 2 more. If not, we'll let this. Wow, silence. Sorry. Oh, I see 2 more. Quick questions. So back there, and then David.
Can I just, is that working? Yeah. No. Yes. I'll speak louder. Cautious optimism from Bertrand, but the numbers that Barry put up, rising dollar, rising interest rates, large proportion of emerging market economies, particularly the poorer ones, at the edge of the distress level, they don't really give rise to cautious confidence. And I'm wondering if some of you could just contemplate what might go wrong, when and how.
Okay, and then there is one in the back. Go ahead.
Yeah, thank you. Very interesting. I have a question on how far there was actually an expansion in safe asset supply, not only from big countries, but also small countries, what Carmen was mentioning. Because my reading was always that because China and many other countries kept developing, that there was actually an expansion of safe asset supply. And some part, like what I've seen, would have been suggesting that you think actually there are fewer countries that can supply these safe assets because their ratings have gone down. So maybe it would be good to have some clarification here.
And one more from Beatrice.
Question for Pablo. You ended up saying that we need a European financing facility and a European common debt instrument permanent. Could you elaborate a bit on that? I mean, the political lines around that argument have been drawn a long time ago, and they have not weakened, to put it mildly. But arguably, the the recognition that there are European commons that need financing may also be growing. So what is your perspective on that?
Okay, so Bertrand, you want to start with China? And I think Carmen also. I'm sure she would want to say something about China.
So maybe on China, what I would say is that obviously China was not a member of the Paris Club. It is indeed an important creditor of emerging and low-income countries, and I mean it was a journey with China, and I think the journey is still going on. Basically, we had to initiate a dialogue. To come to a common understanding, or the early days of a common understanding on how debt restructuring would work. What does it concretely imply, both from the creditor side but also from the debtor side? More precisely, I think it's also important to realize that saying China is a bit short. It's about the various stakeholders in China, because you have got quite a range of players there, from public banks, export credit agency, etc., etc. And I think that what we have been able to do throughout time is to come to agree on some basis of on how we should proceed when confronted to debt restructuring needs. And the best proof of this is obviously that the three countries I referred to. Then clearly, I think we still have progress to make. I referred to transparency. I referred to overall speed of the negotiation. We can clearly do more. As I've already argued, I think it's changing the framework would not change the political reality of this. And I have quite a vivid memory of this kind of discussion or similar discussion with Russia 20 years ago, when Russia inherited debt of the former USSR, and there was a huge work to have Russia being part of the Paris Club, and also understanding how this restructuring were to be handled. The final thing I would mention is that I think that for a more global perspective, in a time where we see so significant risk of fragmentation, I think it's reassuring and certainly good to have a place where such a dialogue is taking place, and where there are working practices, common goals to be achieved, that enables us to bridge gaps with China and to work together with the Chinese authorities.
Very good. Maybe we got Carmen, Barry, and then we go Pablo and Debora.
What I'm going to say is based on a lot of work that I've done with Sebastian Horn, who's sitting right there, and Christoph Trebisch. China as a creditor, let me begin by saying that they face the same issue that all creditors face. They want to get repaid. And they want to get repaid in full. And so the initial debt restructurings that China has offered tended to be of the type that offer you some grace period, maybe extended maturity, but mostly grace period, and it doesn't do a lot for the debtor in that minimal net present value reduction. We've, I think, gone past that. I think a big challenge that remains is that while I think they have moved definitely beyond the model of you're going to solve it with offering some grace period, they haven't gotten to the point where their willingness to actually take principal haircuts are something. And let me say that Western creditors took a long time to get there also during the debt crisis, right? I mean, if you look at, say, the Baker Plan in the mid-1980s, when the crisis had started in the early 80s, it was still debt flow, cash flow relief, and actual write-downs came much later. And I agree with you. We're moving, but we're seeing China move. But let me also say that when you look at their own situation in banking, domestic banking, they're also been very reluctant to write off the large stock of domestic debts. And one quickly on, the question on EM's emerging markets, and, yes, I think they face a lot of challenges. I myself thought that it could be a replay of the 1980s when rates were being jacked up very rapidly. But there are important differences. I think floating exchange rates has enabled many emerging markets to deal better with commodity price shocks and interest rate shocks than in the past. I think also after the Asian crisis, we saw a big impetus towards borrowing more in domestic currency. I think in a period like this where the dollar has been particularly strong, that has helped. And, I think also that the real test for EMs is when three things happen simultaneously. And we've seen two of the three, but not the three. And the three things that I referred to is a significant increase in international interest rates, a reversal in capital flows, and a collapse in commodity prices. We've had two of those three. We had the commodity price collapse in 2015 that hit a lot of particularly low-income countries, but hit also commodity producers at large. And we've had the rate hike, but the rate hike and the capital flow reversal weren't accompanied with a crash in commodity prices a la 1980s or a la 1930s. So anyway, if you got those three, then it's time to really, really worry.
So I would just add on the China point, there are also those troublesome PBOC swaps that countries have been drawing on them to compensate for being shut out of the capital markets. They are opaque. They bear apparently high rates of interest. They're another layer on this problem that China should be addressing. For Bertrand, I commend the Paris Club for improvements in its process and contributing to the common framework, but it seems to me that the stock of problems is growing faster than the flow of solutions to those problems. And there is a growing backlog of countries in distress whose debts our debt problems are not being addressed. Finally, there was a question about safe assets, and that was something that my co-author Sirkin and I also looked at in our Jackson Hole paper. So we adopted our preferred definition of what constituted a safe asset. We looked at the evolution of the global stock and did various projections of the global demand for safe assets going forward. And that rendered us a bit more optimistic about the runway that the United States possesses than many other people, that there is going to be a growing demand for safe assets. There is not a growing variety of suppliers, which leaves the United States, subject, of course, to its credit rating, et cetera. So that runway looks shorter to me, at the end of 2024 than it did in mid-2023. But I'm not as pessimistic about an immediate U.S. debt crisis as some people are, because there is that continued appetite for safe assets of which the United States remains the principal supplier.
Thank you. Pablo?
Yeah, on the arguments not to justify this common permanent European financing instrument, the way I like to put it these days is as follows. No? So traditionally, we've been always emphasizing, or at least myself, I've been always emphasizing the need for this because of stabilization purposes. Okay, so we had the argument of Europe doesn't have an unemployment insurance scheme, for example, or an instrument that can be automatically, without the need of a fiscal agreement, to be provided in case there is a big crisis. And of course, having this will be for sure very helpful, for example, for monetary policy in order to have a good policy mix, no, depending on economic circumstances. Now it's like an additional argument. It was also there, no, in the past, but now the argument is stronger because the argument is based on the fact that we have identified some common European public goods. And of course, if they are really European public goods, it doesn't make any sense that they are financed exclusively by individual countries, because we know that in the end the financing will be lower, it will be insufficient, and it will be inefficient as well. No? The big question that you were asking is about the political appetite. And well, maybe Bertrand is in a better position than myself in order to answer this question. An argument that we've been making, for example, when I was governor of the Bank of Spain, was that the NGO funds, the fact that they were created in 2020, if they work properly, in the sense that they generate the incentives to do reforms, and in the end for those countries that, including Spain, by the way, that have received very significant amounts to grow stronger, this could be, or this could increase the appetite of the European politicians in order to move in this direction. So I think it would be interesting to do such an exercise. So to what extent the NGO funds have really worked as intended. There are some people making some very simple correlations, for example, with Spain. Spain is growing very high. Maybe this is related to the structural reforms that have been done through the NGO funds or the NGO funds themselves. Then why not moving in this direction? No? But I think this exercise would be done deeper. And not based on very simple correlations. But I don't know about the appetite. My perception is that there is not a big appetite for this. But
Debora, 1 minute.
Yeah, I think I follow up. I didn't have any specific question, so I follow up. I agree. I think the appetite is not that much. That's why maybe we have to live with a situation in which there will be no big structural shift in this dimension, but then try to see what can be done. And I think what you were also hinting is if there are EU public goods, we really need to have a coordinated approach, at least at European level, to finance those. And I think that's where there are a lot of also additional returns. So we do some modeling of EIB. It's EIB intervention, but it's actually public investment across countries. So we also have the private, but that's on the public investment. And we see that 20-30% of the effect on GDP comes from cross-border spillovers. So doing a concerted action at European level in different countries can have effect that goes behind the border. And I think with limited resources, we have to take those into consideration at the maximum. And what also I was saying before, when we use the public sector to incentivize private investment, there is a lot to learn about what really worked in the direction that we wanted, and also how to maximize the effect. And I think on the maximization of the effect, thinking of the instrument with a European market dimension rather than national interest is extremely important, again, not to distort the European market.
Very good. So I'm going to close with 3 things. They're going to take me 10 seconds. The first thing, thinking about the similarity with the Becker plan, and we can say like this is the 80s with Chinese characteristics. So the second is a piece of advertisement for a paper. So I have a paper which will have a measure of public investment quality, and you get that when you have high public investment quality, scaling up public investment reduces sovereign risk. This is for emerging market country. And when you have low quality of public investment, scaling up public investment increases sovereign risk, which makes sense. And the third thing is like, thank you.